Chapter 9, then I'm going to do a Quiz 2 review, and we're done, okay? So you'll have your quiz next week, quiz number 2, and then a homework will post that night, which will be due the following week. That'll be your last homework, your homework 6. Okay, so we're rolling right along. So, Chapter 8 ends up by talking about what are the benefits of insurance to society, sort of a collective way of looking at insurance. We don't have to overdo it, it's another list, right? Paying for losses, obvious, managing cash flow uncertainty. You know, if you have insurance, the corporation doesn't have to worry about keeping a fund to pay for claims. Just send it into the carrier. So that is one of the benefits of insurance is you're less concerned about your cash flow other than paying the premiums. Meeting legal requirements. What policies did we say companies are required to have? Anybody remember?
Workman's comp.
Workman's comp, that's one. Any others?
Auto.
Auto, yeah. If they've got cars, they've got to make sure that there's liability insurance in effect. Another benefit of insurance is promoting loss control. And what they mean by this is the insurance companies do it. The insurance companies will offer you loss control. They'll offer that to the company because it's in their interest, right? The fewer claims, the fewer losses you have, the fewer claims they have to pay, right? That's still good for society. Efficient use of resources. Here we're looking at like small business, providing support for the insured's credit. If you're a small business, you go in, try to get a loan or a line of credit, or you even try to get a contract with a company, they're going to say to you, well, tell us about your company and show us your financial statements. And one of the things they're looking for is are you insured? You know, are you insured against liability? So if you make a mistake, there's insurance to pay for the mistake. So this is true. This is a legitimate one. Insurance companies take in tons of cash, premiums, everyone pays, right? We pay them, corporations pay them, and so what do they do with that cash? They invest it. They invest it in the markets, try to make a little money until they have to pay it out in claims. Okay? And last, they reduce social burdens. So if you have auto insurance, life insurance, health insurance, you're less likely, if you have some kind of catastrophic personal loss, you're less likely to go on welfare or to become a burden to the state is really what they're talking about there. So this is our list, the benefits of insurance, okay? Like I say, it's right at the end of chapter. Now we're going to go on to 9, but does anybody have any questions on this list? Okay. All right. Chapter 9 starts off with an economic view of insurance. Now, chapter 9 is talking about the characteristics that make something insurable. Okay? So what do they want to look at? Well, one of the things they want to look at is that insurance companies aren't really selling a product. They're selling a promise, right? You give them your premium, they give you a promise to pay. That's what they give you, a promise to pay. So it's kind of an unusual product. Insurance companies are not going to know the amount they're going to have in claims until the 12 months are over, right? So most policies have a 12-month term. The insurance company doesn't know if it's going to make money on that policy until the 12 months expires. Then they know, well, hey, got another claim. Boom, we keep the money. Or had a couple auto accidents. We got to see if we get sued. We got to see if we lose. And it's going to be a long shot that we made money on this particular policy. So this is an unusual product in that Apple knows if they made money when they sell you an iPhone, right? Ford knows they made money when they sell you an SUV. But insurance companies don't know until the term of coverage has passed. So let's talk about supply and demand, right, of insurance. We're talking about supply of insurance. So what are the influencers of the supply of insurance that's available in the marketplace? The first is the capacity to assume new business. Okay, so here we're talking about the supply of insurance and what influences it. Okay. So the capacity to assume new business is a function of their surplus. Okay? Now for an insurance company, surplus really equals their paid-in capital, right, and retained earnings. It's the money they have to keep. It's the money they have that's theirs, right? Paid-in capital plus retained earnings. The regulators do not like them to write business greater than 3 to 1. So what that means is they do not want them premiums written should not exceed a ratio of 3 to 1. Okay. So if they have $100 million of surplus, the most they should write that year in new business is $300 million in premiums. Okay. Another way to define surplus is assets less liabilities. Okay? So surplus is how much money they really have. All right. The next influencer of the supply of insurance are investment opportunities. Remember, the premiums come in and the insurance company tries to invest the money before they have to pay it out in claims. Okay? So the question is, what investment opportunities are there? Here you got to look at the level of interest rates, right? Interest rates are low. That hurts the insurance companies because they're required to invest most of their surplus when they invest it in bonds and less in stocks because it's too risky for them. So investment opportunities is an issue for them. Okay, capacity to assume new business, investment opportunities. A third thing that influences the supply of insurance are production costs. Right? We must pay our agents. Agents who sell the insurance. then you've got salaries for everybody else. Overhead. Yes, advertising costs. These would all be considered production costs. Okay, fourth would be the regulatory environment. The states regulate insurance pricing. So that if Allstate goes and they want a rate increase, they want to raise their rates, they have to get the agreement of the state. So in Pennsylvania, if you have auto insurance and your carrier wants to get a rate increase, they can't just send a letter saying, hey everybody, we're raising premiums next year. They can't do that. They've got to go to the state first. They've got to go to Harrisburg, and they've got to get the state to agree that they can do it. They have to get permission from the state to raise rates. So the regulatory environment is important. Okay? It's also important on the commercial side, though a little less so. It's a little easier for them on the commercial side because the state takes the position, well, businesses know what they're doing. You know, if they want to pay more, they can do it. But it's really on the consumer products, the consumer insurance policies, where the state gets more heavily involved as far as policing rate increases. So those are our four factors that influence the supply of insurance. Okay? Now I'm going to talk about what are the factors that influence the demand for insurance. Okay? Does anybody have any questions on those that influence the supply?